So, good afternoon, partners, and welcome to this webinar on the impact of the US-Israel versus Iran war and what's the impact on the Indian market and what should be the strategy today. We had actually shared two notes over the last, I think, so 10 days. Uh, I will cover both these notes. And I head the products for the digital wealth business of Anand Rathi. Just one second. I'll just try to disable. Uh, I have just enabled the chat, so probably the chat box would be enabled. So partners, I would be just covering the note, and in between, if there are any questions, you can post it in the Q&A box, and I'll be happy to answer them at the end of the session. Right. So with this, just let me start the session. Yeah. So as we all know, I think so. I'm not covering the backdrop because we all know what has happened over the last 10 days. But we've come out with two notes, and I'll just cover the latest one. It's like what basically how the market reacts or what should be the strategy during this time, because this is not the first time that there has been a war-like situation, and of course, this is not the last time as well, right? But data points is something which we can actually use when we discuss with clients to give them more clarity and actually help them on their long-term wealth creation journey, because these are the events which generally act as the wealth creation journey breaker, right? So this one is the latest note, I think so, which we came out in this week. So basically this note analyzes the economic and the equity market trend during geopolitical uncertainties over the last 26 years. So since 2000, whichever geopolitical uncertainties have happened, how the equity market has actually trended and how the markets have played out, right? So this note also recommends the investment strategy for the clients in this context, which is the ongoing Israel-US war with Iran. So what we've done first is we've looked at the major events or the major conflicts which have happened since 2000, right, which has impacted India. And there were 12 major wars or conflicts which have been recorded, major ones, right? Uh, that what had happened during this time, and on that balance, what Nifty delivered during that period. So there is one chart which was there in the earlier note, which was this the major conflicts which have happened over the last 26 years, and these are the 12 conflicts. It started with the Gulf War, right? And then the US Israel, the India Pakistan conflict, the Russia Ukraine conflict, and so on and so forth. What we've done is we've looked at the war period and, of course, the intense phase also, where the war was really intense. But generally, the war period, this is like the start date, say the last one, say the 7th May 25, that is the India Pakistan conflict, and 10th May is when the war ended. It was a 3-4 day event, right? But what had happened to Nifty during this period is something which we have been looking at, right? That what was the returns of Nifty? Because see, we have to cut the noise. So what actually has happened? So during these 12 instances, the impact on Nifty is that during the entire war period, uh, just one second. The mean Nifty returns have been 10%. The median is like we just take the midpoint is 10.2 and the worst case is 7.4, right? So the mean return over the entire war period has been 10%, means Nifty has been positive. That's the first part. That is what data is suggesting. See, we have to clear the noise, and of course, data is something which helps us. That's why we are showing data. And this is something which will give you as well as the client more confidence on whether to invest today or not, or whether to stay invested or not today, right? Because during the time of COVID, also the recent one which we had, during that time, also the sentiment when the markets correct is something which is very extreme, right? But then data always suggests something else. So if you go by data, then that is what will give more credibility for the client to remain invested and to add more money. So this is what has happened in the past conflicts or wars which have occurred, where the worst case returns have been minus 7.4, the average is 10%, the median is 10.2. So one of the major impacts of the ongoing war is been the sharp rise in the global crude oil prices, which I am damn sure everyone knows what is the current crude oil prices. So this is also something which we have checked, that the average increase, see, this is the average increase which has happened over the last 8 instances when the markets have been volatile due to war or any other conflict, when the oil prices have shot up significantly. So the average increase in the oil prices over the last 8 instances from since 2000 has been 150%. That's the average increase, right? Currently, also, I think so. If you just look at that 65 to, we've been at almost 100, 119, I think so, which it went, right? So that is almost, you can say almost 85 to 90% movement has already been seen in the oil, right? This time as well. So average has been 150%, but the most critical and important part is that if oil increases, India is a net importer of oil, right? So currently we have, it's almost 4.5% of our total GDP. But since we have dependency on oil, oil is a major factor for us. So what has been the trend? That during this 150% rise, the average increase in retail prices of petrol and diesel in India during these phase has been 10% only. That is the max. And that too also in a phased manner. It is not that the government has increased it immediately. So the impact on inflation is something which we are referring to, that will there be a major impact on inflation due to the increase in oil? The answer doesn't suggest, because the 10% is the max increase which has happened in the petrol and diesel prices of India during these last phases. I'll also cover the major rises which has happened. It's there in the table here. These are the 8 instances where the price increase has happened. So the latest one was, of course, August 21 to March 22, right? This was primarily, I think so, due to the Russia-Ukraine war, which was 100%, and so on and so forth. There have been various instances which have been mentioned here, right? But the impact on Indian market and Indian GDP is something which we have to look at. See, because see, everything put together, and we've been always discussing this over the last, I think so, 5 years post COVID, that what does market look at in the long term, what does market look at in the medium term, and what does market look at in the short term, right? Now, in the long term, market is decided by the GDP growth, by the interest rate movements, by the inflation, by the fiscal deficit, right? Now, inflation doesn't look like that there will be a major negative impact, because the oil prices, even if it increases, it will be in a phased manner. That is one. We've also looked at the GDP growth during these instances when the oil price have moved very sharply. 1 year before the price rise, the GDP growth has been 6.2%. The inflation has been 5.3%. During the price rise period, the GDP has grown at 7.2%. The inflation has been up by 10%, which is 5.8%. And 1 year after the price rise, the GDP has grown by 6.7%. Then the retail inflation has remained as it is at 5.9%. So this data is again substantiated with what has happened over the last 8 major instances when oil has increased by more than 150%, is that the GDP impact has been negligible. GDP has grown at the rate which has been what is expected. Current year, we are expecting a 7.6%. Next year, we are expecting a 6.5% growth in GDP. The inflation, this year, of course, the number is 2.1. Next year, the expectation is that the inflation will be around 4 to 4.5%. So we are expecting a nominal GDP growth of around 10.5 to 11%, right? That is something which remains intact. And what the past data also suggests is that the GDP growth hasn't been impacted much by the sharp increase in the global crude oil prices and the impact on the GDP and retail inflation. So see, we have to cut the noise. The current event is, of course, a short-term event, but when we look at the long term, what factors impact the GDP and retail inflation, that is something which is on track. Interest rates currently have been, there's been a 125 bips cut over the last 1.5 year. We are not expecting a major rise in the interest rate. That is something which is not there around the card. So if the inflation increases to say 5-6%, then probably the RBI might intervene. But currently, that is not something which even the RBI is anticipating, right? So all these 3-4 long-term parameters look on track. The GST number also, which we came for Feb, was 1.85 lakh crore, which is a shorter month, right? So that is also in line even after the cut in the GST rate. So all these 5 factors are on track, right? The impact is something which doesn't look like it's going to impact much if this event which has happened. So that is the first part, right? There have been Then the second thing is there have been 7 events other than the wars where market witnessed a significant correction. It was seen that most large correction in markets were on back of significant rallies over the previous years. Now, why we are actually highlighting this data is, see, because there is a lot of short term, there's a lot of news or a lot of rumors which have been coming in that there can be a domino effect, or then things will slowly and steadily, it will percolate to everything. It can be, it can't be. That is something which is anyone's guess, right? But even if we look at the major correction, see, if this is something which does happen, then what happens is that there's a major correction in the market. Now, what we did is we looked at the major corrections in the market other than wars over the last, I think the last 30 years is something which we've looked at, more than 30 years, that what have been the major 7 corrections in the market. One thing which has been common is that the markets had always rallied before the correction. So this is the data for the last 7 periods which we've been highlighting here. That last one is, of course, the COVID and the subprime crisis, which we all remember. The last 3-year returns prior to this event was that the markets delivered 42% per annum. That's the CAGR returns which the markets have delivered. Currently, if we look at the last 1.5 years, the markets have been negative. So market is not something where we've come on where the market has rallied a lot and that's why there is a huge scope for correction. The answer is no. That is something which is doesn't look like where the market has not moved, right? Even if I look at say 18,000, it's been a 25%. It's like it's been hardly 7-8%, 8 to 9% growth over the last 3 years. If you look at, right, that is the first point. The second point is the absolute fall from the peak. The absolute fall has been an average of 47%. The latest one, of course, was COVID, which was approximately 40%. The subprime crisis was 60%, right? But the important part is from that drop, the next 3-year returns have been almost 34% per annum. So 42% before the fall per annum, a 47% absolute drop, and again a 34% per annum returns over the next 3 years. So this is what the market has delivered. If there is an event which is like, say, when the markets correct significantly, this is what markets have done. So currently, one major benefit which we have is that the market has not been very given above average returns over the last 3 years, right? That is the first part. So that, of course, limits your downside. The second is that whenever these sharp corrections have happened, they've been short-lived and not been permanent. And market basically reverses over the next 3 years and it gives a higher than average return, which is also something which we've seen over the last 7 major instances other than the wars in which markets have delivered 33%. So why I'm highlighting these data points is that data points is something which would help the client stay invested and add more money. This is a similar data point which we had shown even during COVID. So I'm damn sure some partners who would have been there since COVID, they would have seen such kind of a note even during that time, because even during COVID times when the markets were at 8,000, 9,000 levels, the confidence was low of the clients as well, right? But the next 3-year returns were something which we've all witnessed. So during this time as well, data is something which would basically cut the noise. So this is something which I wanted to highlight again. So what is the current event impact, right? So Nifty is currently down by almost, you can say almost 11.5% from the peak, which is 26,300, right? Which we witnessed on 2nd Jan. Since 2000, the market has experienced an average drop of 18%. So, and this data point is again a short-term data point where we've looked at per annum returns of Nifty, right? And what has been the correction in each financial year for the last 25 years of the peak in that year and the trough in that year. The average correction is 18%. If you remove the 2 extreme years, which is the COVID and the global financial crisis, the average correction is 14%. The current fall is already 11%, 11.5%, right? Indicating that the market correction is in moderate and within the normal volatility. It is not something which has gone out of control, right? And what we've seen is what has been the returns of the market from the rebound over the next 1 year, 2 year, and 3 year, 1 year, 3 year, and 5 year, and also the tenure in which how much time the market takes to correct and how much time the market takes to recover. So this 18.7%, which is the average fall, and the median fall is 15%. The time taken to fall has been almost 3 months. The average fall, the average time to drop, say an 18%, has been 3 months. The recovery period has been almost 1 year, right? The median is 9 months, the average is 1 year. So in 1 year, the market recovers. The next 1 year CAGR return is 32%, the 3 year returns is 20%, the 5 year returns is 17%. So all these returns are above average. So when we actually speak to clients also, the client is also not investing for a short term period. Or the client say who would have invested say a 2 months ago or a 3 months ago or 6 months ago, or say even a 1 year ago, right? The client has not invested for 1 year period. He's invested for a 5 year period, right? So this is something which we have to reiterate that, sir, if the markets have corrected over the last 3 months and your returns are negative, but we've not invested for the 1 year period or not invested for a 3 month period. We've invested for a 1 year period. Does that thing change? The answer is no, because one thing which I explained is that the long term view on the market remains positive. There is not much change which is happening, even if the oil prices, which has increased, doesn't impact much the retail inflation, the GST collections which are there, the GDP numbers which are there. The second is, of course, the corporate earnings, right? As it is, it's like if you look at the recent equity market view which we have shared, there also we've reduced the expectation of growth for this financial year and also for the next financial year. It's like even this financial year and next financial year also we've reduced that growth. So even looking at that and a reasonable valuation, the Nifty should be around 28,800. That's what the number suggests as of March 27. That is 1 year from now, right? So based on that also, that too is on a earnings number which we have reduced. So we were expecting a higher growth, but as the companies start moving to the next financial year, that number has also been dropped to 11%. So even after that, and 11% is something which we've seen that over the last 25 years, that's a normal growth which the corporates have delivered. So it's like the real GDP growth has been 6.5%, and corporates have been able to add 4-5% over and above the real GDP number. So even if I look at that number, 11% is something which is a reasonable expectation. And based on the reasonable P multiple of Nifty, we should be around 28,500 as of March 27. So even on the medium term is something which is intact. It is not something where we've come like a COVID scenario where everything is closed and we don't know what is going to happen. That is not the case, right? So even that is something which supports. So when any client invests, say invest today, so of course the numbers suggest that he should add more money or he should invest immediately. But someone say would have invested 3 months ago or a year ago, even that client should stay invested and if possible add more money, right? I will also share the numbers, but this is what the data is suggesting. Moving ahead, see, amid this, so basically it's like in this financial year, as of yesterday, Nifty was flat. Nifty had delivered around, so this was 2%, this was as of 6, but as of yesterday, that is as of 12th March, Nifty returns is flat. It is around 0.5%. Mid cap has delivered around 6%. Small cap is also negative, which is, I think, so around negative 2%. During this time, our model portfolio has delivered around 8%, and our Wealth Plus portfolio has delivered around 9%. So someone with a Wealth Plus strategy, right, has of course seen better returns over the last 1 year, where mutual funds have delivered, and of course the structure has delivered. The one who has in the money is showing positive returns. The one who has, say, taken a primary product, his probably portfolio is not showing negative. It is the cost which is there. but it is not participating on the downside as well. So it's been flattish as well. So that's also something which has been positive, where the one who's followed the entire strategy has also can see the difference in the overall portfolio. So basically, domestic sentiment remains positive because net flows in even in the small cap funds have been positive. It's like Jan, Feb, we've had positive flows, and even in the March, based on our calculation, we thought that almost 700 crores is something which would have been added in the first 6 days in these small caps. So flow is something. It's like if you look at the DIF flows also, of course the FIs have moved out money, which they have. It's not this financial year; they've been doing it for the last 2 years. But DIs have been adding money, right? And that is something which has been the positive for the market. So what are we suggesting here is that with the geopolitical conflicts create uncertainty, no doubt. Historical experience and current market indicators suggest a low probability of a deep or a prolonged correction in the Indian markets. The current decline is well below historical average, and resilient domestic fundamentals and continued investor participation support market stability. So that is something which has been a support for the market. Of course, if you all would have seen, the SIP numbers were also almost 29,000 crores for the month of Feb, right? So this is, of course, a valuable opportunity for deploy fresh investments in the Indian equity in the long term. So this is something which should definitely be used as an opportunity where we actually go back to the client and tell him and show him these data points that what has happened and what is expected of the Indian markets. So if this correction happened, this is of course a short-term event. This short-term event can be anything. See, markets have corrected 18% every year over the last 25 years. The reasons would have been different, right? It would not have been the same reason. But market have always rebound, right? So it is that always when the corrections happen, and of course today the market's almost corrected by some 400 points, right? Nifty corrected by more than 400 points. So during this time, of course, the sentiment is that what to do, should we wait, should we add, will the market correct or not, till when it will stop, all these questions will come in. The rumors will be much more, there would be a lot of talks which would come in. Our role as an distributor, of course, is to show him the data, show the client the data, which is critical, because he is not investing for a 3 month or a 2 month or a 1 month or a 15 days, right? He's investing the money for long term. And what are the factors which impact in the long term is something which we have to reiterate. Also give him the data points that what happens during these times when the market's correct, that the impact of oil on inflation, impact of oil on GDP, then also the corrections which has happened during wars, how the markets have reacted. This is not the first time, this is not the last time. Except wars, what scenarios have been there, that how much markets have delivered before that event, how much market has delivered after that event, and how much markets have corrected during that event, right? So all these data points is something which we have to show it to the client. I think so that will give him more confidence to remain invested and actually add more money, right? Because he's ultimately a long-term investor. He's not someone who's a short-term investor. And this is, of course, the time to use. So the ones who have taken plan B, I think so they could see the difference in their portfolio. I'm damn sure they could see the difference in what the portfolio has been. It's like the markets have corrected, say, in this month around, it's been, I guess, around 6.5%, right? Uh, but the structure wouldn't have corrected so much, right? So that is something which even the clients can see. So that's why we always suggest a wealth plus proposition, which is a combination of mutual funds and structured products, because this is something which will help to create long-term wealth creation. We have to go through these journeys, and we've always said that markets will not deliver linearly. Markets will always be give returns in a differentiated manner. There can be periods of supernormal returns. There can be periods of subpar returns also. Last 1.5 year, markets have not delivered anything. It's been negative only, right? It's like from the top recently, we've fallen almost 11%. So this is not the first time the markets have fallen. This will not be the last time. Even after, say, there is a rally, even after that next year, there will be some other reason which will help, which will actually lead to a market correction. But you have to show him the data points, because this is something which would help him, give him that confidence of staying invested in the market. And if he stays invested, then only he'll make those returns which we are expecting of 12 to 14%. So that's why this was a short note which was shared, and I thought we will just cover this as well so that you can take it to your clients because this would help you. Data points is something which is critical when you show it to the client because that will give him confidence. These are the annexures which are there, that what has been the major wars which have been considered, and of course uh, the major instances when the crude prices have increased. But this is a short note which I thought we would cover. So again, just reiterating a few things, and then probably if there are any questions, I'll take the questions. So what should be the investment strategy? So first, you can show him the data that whenever there has been a war, 12 such instances, markets have been positive during that time. Second thing, that what is the impact on inflation and GDP? So the impact is marginal. GDP has been higher. We are expecting a 6.5%. So that is something which is well in line. The second part is that except the war events, major corrections which have happened, it has all happened when the markets have given supernormal returns over the last 3 years before that, which is not the case currently. So that again merits that the markets might not correct deeply. Whatever corrections that happened, the absolute drop was 40%, but after that, the markets have delivered almost 33%, 34% per annum after that. So what we've seen is that whenever the markets even does correct, or say there is a domino effect, which is something which always comes along, that this news is there, this news is there, this news is there, and it might lead to a domino effect. Even if that comes in, the next 3 year returns have been 34, 35%. Right. So even that gives comfort. And this is something which we've seen that is always short lived, it doesn't go on for long. The third part, of course, is that what has been the fall every year. This is a major short-term stat that every year the markets correct by 18%. It takes almost 3 months to correct, but within a year it rebounces. And the average return of 1 year has been 32%, to 3 years has been 20% per annum, and the 5 year has been 17%. So that is what the market has delivered. So this is something which we have to again go back to the client and explain him that, sir, when we look at the markets, we look at what impacts in the long term, what impacts in the medium term, what impacts in the short term. Long term GDP on track, retail inflation, as it is, we are expecting a 4.5%. We are not expecting a 2%, which is the inflation this year. Right? The interest rates well within range, the fiscal deficit is within range. So there is nothing which is alarming there. The second is on the earnings part. So earnings, as it is, we have reduced the earnings, right? So we are expecting based on earnings 11% growth, which is in line with what corporates have delivered over the last 5 years. You can say that markets have delivered that. So if that is the case, then the market reasonable level should be 28,500 as of March 27, right? That is the reasonable level of Nifty based on the earnings. So then again, it's fundamental. Third part is of course short term. So what has happened in the short term is something which I just spoke, that what has happened in the short term and what is expected, that how market reacts. So that is something which I wanted to highlight through this note. If there are any questions, I'll be happy to take them. I'll just stop my sharing and I'll just look at the Q&A box. So what is the impact on the debt investment? See, currently there is no impact on the debt investments because debt has been able to deliver around 6.5%. Currently, there is no impact as such on the debt part. And see, it's like if you look at the yields also, yields have been stabilized at around 6.5, 6.6, 6.7. That's where the yields have been. So yields have also not been moved much as such. So and see, the oil breakup is as such, we import hardly anything from Iran. It was just 2%. Majorly our oil is coming from uh, Russia, which is almost 35%. And US has been saying that currently temporarily remove those sanctions. So that is also something which is not a worry. So oil as such, the impact of oil, there was a video which we had shared of Feroz, right, where he said that probably, I think so, 10 years ago or 15 years ago, the impact of oil, so the oil imports were almost 15% of our GDP. Currently, it's around 4.5%. So, of course, the dependency is there, but the impact has been reduced. So, impact on debt as such currently is not much, I think so. Should we move amount from SP to equity if asset allocation supports? See, always you should look at 60/40. If the allocation is more in SP, then probably we can get more monies from the client to adjust the allocation. You should always try to keep the allocation at 60/40 uh, at this or any moment. I think so. That is what we should do. Another thing is most of the times I think so we are not sure of should we invest the entire amount, should we do an STP. Uh, See, it's like if the markets have corrected, if you want to do an STP, but don't do an STP for say a 6 months or a year period. I think so. When the markets have been correcting and the markets are where it is currently, I think so. You can do an STP for max a month if you want to, and invest that money. Don't keep it for a 3 months, 6 months, 1 year period because that is too long. It's like you will not be able to utilize the exact impact of this. See, I'm not saying that the market. No one knows that the market might correct to 20,000 or market might go to 25,000 again. That is something which anybody's guess is. Then no one knows what will happen. But if we are at currently 23,200, I think so today's level is right, and that is I think so. uh, The reasonable level should be around 24,900, 25,000 as of date, based on earnings. 28,500 is something which we are expecting. Now you're getting the market almost 7-8% below the reasonable level of Nifty today, right? So then we should not try to time the market further and keep a 6 months, 3 months period for STP. That is something which I would not suggest. You want to do an STP, then max is something which you can do a weekly STP for a month, but not a 3 month or a 6 month period. I think so. I have answered the next question as well. Uh, Jay, I think so. I've covered that note. Is like how the current market is an opportunity. It's like how you can utilize this because you can show this note to the client because data suggests that markets have delivered when during these times the markets post these wars the markets have delivered above average returns. So I think so this note covers that. It's like that. So why gold and equity is falling together? See, as such, they've never been negatively correlated. We've always seen data where the correlation has been actually zero or slightly positive. It's never been negative as such. That's what the data which we'd seen. We'd also looked at one more data point where how much gold prices increases during wars. So the gold price increase was actually marginal. It was not significant that it will increase by some 30, 40, 50%. We've actually jotted down in that note as well that the gold prices or the oil prices increase have been marginal during wars. So currently, I think so that is what has happened. And of course, it was on the backdrop of that the gold and silver had moved really significantly over the last 6, 8 months. So uh, it's like gold has been steady, equity has been still been more volatile, I think so, over the last 10 days. But there is no, as such, any specific reason as such. It's like what data suggests is that gold doesn't increase much during wars. That's what the data suggests, which we have looked at for the last 12 instances. How will it impact on sectoral funds? So we don't recommend sectoral funds. Probably this is the precise reason, sir, because see, in sectoral funds, everything goes through a cycle, right? And we have a fund manager in a diversified fund who will take calls, increase allocation to sectors which he feel is positive, decrease allocation to sectors which he feel is negative. Now, during these times, when say suppose any sector is impacted much more, and if you have invested in that sectoral funds, your returns would be further impacted, right? Because the fund manager is not expected to take any call, right? He has to stay invested in that sector. So, say if that particular sector is impacted, he will have to stay invested. Probably he can just change the stocks, but he can't change the sector. So that's also one of the reasons we don't recommend any sectoral funds because during these times the volatility is much higher in this. So we don't recommend any sectoral funds. Investments by clients, I have covered that. As such, so no, as I said, sir, safe havens, gold and silver. As I mentioned in the earlier note, also it is there that gold basically, silver, sir, is something which has been as it is too volatile. But gold as an asset class, which is generally considered as a safe haven. During the wars, over the last 12 instances, gold has not delivered much, sir, during the war period. So the data doesn't suggest that it actually goes up during these times. So Yeah, so leverage, of course, is 20% over and above. So 100 rupees is what the client has, which should be invested in 60% in mutual funds, 40% in structure. 20 rupees is over and above the 100, which we have to add. And that 20 has to be added in structure product because it has a higher probability of delivering, right? The spread is, of course, better and the probability is higher, and you have to limit it to 20% and 20% of the overall 100 rupees. So say the client has investment with us, but the client would be having investment outside also. He would have investments in fixed instruments, in real estate, in gold. All that put together is 100 rupees. Ideally, the client should have 20% leverage of that 100 rupees and not say only investments of mutual funds is something which can be considered, or only stocks or FDs. No, you have to consider the entire 100 rupees, which is stocks, mutual funds, real estate, debt, everything put together. That 100 rupees that 100 rupees over and above that, you have to take 20% as leverage. That is where the 20% comes in. We suggest don't go over 20% because then during the downside, the impact can be higher. So 20% is, I think, so something where we feel that's the sweet spot there. So as we said, so we don't suggest or recommend thematic sectoral schemes, sir, because the fund manager will do that job for us, sir. It's like if the defense story looks good, or the pharma looks good, or the IT looks good. We don't suggest that, sir, because it is not a one-time recommendation or a suggestion to invest, right? It requires continuously tracking, monitoring. Multiple things have to be looked at, sir. And for that, we have the fund manager, a diversified fund manager, who will do this for us. So we generally don't suggest investing in any particular theme as such because the fund manager will do that job for us. So, of course, unrelated, but on this, so there have been stories of around, so there is the impact unrelated question on this, but there's how much the STT impact would be on the arbitrage funds. What we have seen is that there have been suggestions of around 0.3 to 0.5% impact, which can be there in the returns per annum on the arbitrage funds. So what we had also seen is what we suggested is we look at the performance of the arbitrage funds, say till the month of May, and then we'll decide that do we want to continue with arbitrage funds or we change the debt funds, and accordingly that would change in the SWP plan as well. So we'll wait till the mid-May or end of May, and then we'll decide on if we require any changes in the arbitrage funds. Any more questions, partners? You can put it on the chat or the Q&A box. I'll wait for 2 minutes. Any more questions? Till the time the questions come, I think so. One thing which is very critical, partners, which I would suggest everyone to do is actually be in touch with all your clients. Speak to them, understand their requirements, understand if there is any uh, monies which is there which they can invest in, understand if the client has any portfolio which is outside Anand Rathi, how that portfolio is doing, who is suggesting. See, this is a very good opportunity to actually get more monies from the client, get more AUM from the client, speak to the client, because these are the times will define and differentiate you in the eyes of the client. When if he's having say 4 5 or 3 4 distributors, right? If we can actually give him data points as such, right, then I think so this is something which is the most critical part. This will differentiate us amongst the rest. So most important thing is you have to actually discuss with your clients, each and every client. Speak to him, show him these data points, share with, I think so we've shared small WhatsApp messages also which you can share with your clients. Speak to them, ask about their requirement, ask about the availability of more funds, ask about the overall portfolio. Give him the confidence to stay invested, give him the confidence to add more money. I think so this will differentiate. this is the time to actually speak to all the clients, because even as the markets correct every day, the client will of course be worried of his investments. What to do, what not to do. Should he wait? Should he add? Or should he redeem? Right? Someone say inclined more towards FD would feel that equity is of course volatile, doesn't deliver negative returns, FD is better. ये सब चीज दिमाग में आती है client के. So at this moment, it is very critical that you actually connect with the client. This will really help you also to build a higher AUM and actually retain the client for a longer period of time. If you can actually give him data points rather than just saying कि नहीं नहीं sir market में invested रहो कुछ नहीं market recover हो जाएगा. See, this is a very generic statement, but if you can give him data points, I think so that will add value to him, and of course it will differentiate you as well. So please use these data points with all the clients you have, be it your mutual fund clients or your stock clients or your FD clients or your insurance clients, because every client will have investments. It might not be with you, but if you can actually give him more information and give him more knowledge on what he should do at this moment, I think so you can really get more monies. This is something which we have observed across, even when the markets have fallen over the past periods, where partners have been able to get more AUM and monies during this time, provided you give him the data points. So it is very important that you be in touch with your clients and try to connect with him. Don't wait for him to call you. I think so. We should proactively go and call him and just give him an update on what is the expectation or what the markets have been. I think so that will add more value. If I'll just check if there are questions. Indian markets have not corrected the highest. I think so. Taiwan or Japan has corrected more. Puneet. Even US has corrected during this time as well. Uh, it's like in the fall. If you check in the fall, I think so. Large caps Nifty has corrected more. The mid and small have not corrected equivalent to what the Nifty has corrected. I think so. Today, I think so. The mid cap and small cap corrected more, but otherwise the correction has been majorly in Nifty. So we've been down by around 6%. I think so. I've not checked on the US what they have corrected exactly. I don't know the numbers, but I think so. Nikkei, Taiwan, or even Hang Seng has corrected more. Uh, that's there. So the data points are I think so. Your BDM will get in touch with you, or you can get in touch with your business development manager, and he'll be happy to share the data points. Is there on WhatsApp? He'll be able to share it with you, which you can share it with your clients. Yes. So for new clients, of course, we suggest 60-40, sir. That will always be the strategy of 60-40, 60% in mutual funds and 40% in structures. We will not change the strategy, sir. It's always been 60-40, and it would be. My views are on the market bottom is something which, sir, can't suggest. No one knows what the market bottom is. Will it uh, will it move and turn around from today's level, or will it go down further? That is anyone's guess. We should not even try to get there, sir, because no one will try. No one will get the bottom, right? If we actually look for the bottom, then I think so. That's where we are starting. The starting point is only incorrect, because even if the client says नहीं मेरे को bottom में ही डालना है, सर किसको पता है bottom में? सर आज bottom हुआ है कि 2 महीने बाद होगा? No one knows, right? But if I'm investing and I'm investing for a 5 year period, then what do I look at? What does the market look at? I think so. We have to reiterate the equity market view, which I said, right? Where we look at what do you look at long term? What do you look at medium term? If those parameters are in line, sir, I know I will make returns, right? And with this opportunity, you're getting a further discount. So you should utilize that opportunity rather than actually wait that what would be the bottom level and then I'll invest. I think so. That is something which will not lead us anywhere, nor us nor the clients. So as I said, that this mid and small have comparatively, it's like if I look at today's number, it would be more or less similar to what the large cap has recorded. So overall, all three have been similar in performance over this month as such. There's not been major difference. We still have allocation, of course, 45% in mid and small and 55 in large. So even that will add to more kicker when the markets rebound, right? So that will always be there. But currently, we don't expect any changes in the allocation in large, mid, and small. I think so. We will stick to that, and we'll stick to the model portfolio. Over 3 year time frame, as I said, so we would stick with the 55 large, 23 mid, and 22 small. We would not move against that because it is not that, see, 3 years, how the markets be after 3 years, of course, we've seen the numbers, right? But how the things move is also something which is very critical. That the rally comes, say, first in the large cap, then in the mid, and then in the small. And say if I'm very small cap heavy, and say the returns come, say, after 3 years, then the client will be like, boss, you told me to invest, I invested, but the returns have not been there. So that's why it is not that you just bet on one thing at this moment and just hope that things would be good, right? Multiple things happened. So during COVID also, of course, small cap, mid cap fell more than the large cap. But the first recovery, of course, came in the large cap only. And specifically in the first 6 months, it was specifically certain stocks, right? So in the journey, that's why we have a 55, 23, 22 mix in the overall portfolio. And I think so we should stick to that. So as it is, we will not comment on the stock, sir, but the mid cap percentage, the 23% is in mid cap stocks, right? The 22% is in small cap stocks. On particular individual stocks, sir, as I said, that is not our role. That's where the fund manager will do it, sir. He will do the selection. He will do when to buy. He will do when to sell, when to add more money. That is where he is the expert and he would do this for us. So rather than getting into stock selection, we feel the fund manager will do this job for us. Okay, partners, thank you for patiently listening. Have a great weekend, and I hope that you actually reach out to all your clients because this will definitely help everyone to get more confidence and give more confidence to the client as well. And we have, I think, so the weekend it would be a good time to actually interact and check with your clients as well. So thank you, partners, and have a great evening. Thank you.